Let us examine the core processes essential for success in stock investing. Stock investment should not be understood as a zero-sum game where someone wins and someone loses. Rather, it is a structure in which all participants can generate profits together. As Warren Buffett famously said, the principle of never lose money is crucial in investing. This does not simply mean avoiding losses, but rather establishing a foundation to survive in the market and invest over the long term. Therefore, avoiding large losses and investing steadily is the fastest path to accumulating wealth over time. Human nature strongly tends to avoid losses, leading investors to hold on to stocks without acknowledging losses when prices fall, while quickly realizing gains when profits occur. This behavior results in realizing small profits but enduring large losses. Successful investing requires a strategy that maximizes gains while minimizing losses. Stock investing is a probabilistic game involving uncertainty about the future. Over the long term, the probability of stock prices rising or falling is roughly 50% each. While stock prices have no upper limit on gains, there is a limit to how much they can fall. Theoretically, the expected value is positive. However, psychological factors cause investors to magnify losses and prematurely realize gains, often resulting in actual losses. An effective investment method is the trailing stop-loss strategy, which involves never selling while the stock price is rising, but preparing to sell when the price falls more than 10% from its peak. To reduce losses, investors should set a stop-loss price at the time of purchase and adhere strictly to selling immediately once that price is reached. This is not about locking in losses, but about preventing larger losses and creating opportunities for new investments. In stock investing, selecting the right stocks and timing the sale are critical. Investors should choose stocks recognized as market leaders rather than those they personally like. Market leaders are stocks that are rising with clear reasons behind their upward movement. For example, in the current Korean market, the semiconductor sector is considered a leading sector, with Samsung Electronics and SK Hynix as representative companies. Selling simply because a stock has risen significantly is an evaluation based on the past. Investment decisions should be based on future growth potential. A low stock price does not necessarily mean the stock is undervalued. Stock investing is about buying the value of a company, not just purchasing an item, so distinguishing between price and value is essential. Representative valuation metrics include PBR, price-to-book ratio, and PER, price-to-earnings ratio. PBR indicates the stock price relative to the company's net assets. A lower PBR suggests undervaluation. PER shows the stock price relative to net earnings. Similarly, a lower PER indicates undervaluation. These indicators are used to compare similar companies to assess relative undervaluation. Investors are advised to rely less on excessive information and invest within the scope they understand using key indicators. Excessive information searching can confuse investment decisions, and in fact, investors who are less sensitive to information sometimes achieve higher returns. Therefore, learning to invest should not be like preparing for an exam, but rather like playing a soccer match, gradually acquiring experience through real practice. Misconceptions about long-term investing should also be corrected. Holding a single stock for a long time is not true long-term investing. Genuine long-term investing means participating in the stock market over an extended period while managing profits and losses. It is important to adhere to the principle of selling when prices fall and holding when prices rise. ETFs, exchange-traded funds, are useful tools for beginner investors or those uncertain about stock selection. ETFs are funds that invest in multiple stocks, and index ETFs provide exposure to the entire market. However, simply increasing the number of stocks does not necessarily improve returns. Concentrating investments in stocks with conviction can be more effective. Regarding the future outlook of the stock market, although the Korean market has risen significantly recently, it remains undervalued, a phenomenon related to the Korea discount. The Korea discount stems from complex factors such as corporate credibility issues, inadequate dividend policies, and corporate governance problems. However, recent amendments to the Commercial Act, changes within companies, and increased participation by domestic investors are gradually resolving these issues. Particularly active participation by domestic investors is expected to attract more foreign investor interest, thereby revitalizing the market. Stock investing is not merely a means to make money, but plays an important role in creating a virtuous economic cycle. When companies return profits to shareholders as dividends, shareholders' incomes increase, leading to higher consumption, which in turn fosters corporate growth, forming a positive feedback loop. Such changes in the economic structure can contribute to the sustainable development of the national economy. Finally, the most important aspect of stock investing is to rigorously adhere to principles and processes. Investors must develop strategies to minimize losses and maximize gains, avoid emotional decision-making, and maintain consistent record-keeping and learning habits. Beginners should start within their capacity and gradually build their investment skills through experience. Through this process, investors can establish a foundation not only to become wealthy, but also to remain wealthy.